Hi, this is Daniel DiTuro. Are you using credit to save and make money? In this video, I'll share Debtor Nation, using secured debt to make money, unsecured debt and losing money, and avoiding high-interest store credit cards. As of 2024, U.S. consumer debt was $18 trillion, up $10 trillion since 2004. Part of the increase is due to the increased cost of housing and to the increased cost of credit. Consumer debt includes home mortgages, auto loans, credit cards, student loans, and short-term loans. About 3.5% of consumer debt is delinquent. Nearly 50% of Americans use monthly credit payments to pay for essential expenses. Those expenses include housing, utilities, transportation, groceries, clothing, cell phone and internet, healthcare, insurance, childcare, groceries, maintenance, and repairs. There's nothing wrong using credit to pay for goods and services if you have or will have the money to pay your debts. Unfortunately, about 50% use high interest rate credit cards to live beyond their means. There are two types of debt: secured and unsecured. Secured debt includes auto loans and home mortgages. Interest rates for secured debt is much lower than unsecured debt. When a person defaults on a secured loan, the property is repossessed by the lender and sold to recoup the loan balance. Investors use secured debt to make money, like flipping houses or buying and renting them. Homeowners may break even, make a profit, or lose money. Mortgage lenders and financial planners recommend home loans to free up money for investments. But many use the money to buy depreciating assets or credit cards for travel, entertainment, and living expenses. Instead of using money to make money, they have mortgage, auto, and credit card debt. The interest rates for all that debt depends on your credit score. While home and auto loans have fixed interest rates, credit card interest rates can vary. If your credit score is excellent, you may only pay 18.9% credit card interest. Miss or stop making payments, and the interest rate can increase to 29.9%. High credit card interest rates are due to credit card debt being unsecured. In 1978, the U.S. Supreme Court limited states' rights to regulate interest rates, and consumers complain but still use high interest rate credit cards. As a result, credit card issuers make over $100 billion a year on interest and fees. Because credit card issuers do not repossess goods and services, if you default, your debt goes to collections. Collections and bankruptcies affect more than access to credit and low interest rates. Some states allow auto and homeowners insurance companies to use credit scores to determine eligibility and calculate premiums. Credit scores are also used to screen renters. Maintaining a high credit score means lower interest rates, insurance premiums, and increases renter eligibility. If 19% annual credit card interest is not bad enough, many store credit cards charge up to 35%. They entice shoppers with 10 to 25% off their first purchase. The savings evaporate if you make monthly payments. In addition to higher interest rates, most store cards can only be used at the issuing store. If you make monthly credit card payments, use credit cards with the lowest interest rate. Your credit score will plummet if you have too many credit cards with maxed out credit limits. Save money by cutting up, not closing, high interest rate credit card accounts. Their credit lines are used to calculate your credit score. Eventually, the issuer will close inactive accounts. If you maintain a high credit score, the credit line reduction will not significantly affect your credit score. Please leave a comment if you have any questions about this video. Thank you for watching.